The drawdown was crazy, no question about it. You know, you look at a few things that have precipitated these drawdowns. You talk about the Bloomberg headline that ran cover for the paper smash, as far as I'm concerned, where they said Russia was going to jump back on the dollar standard. And this precipitated forced index selling, and along with the margin hikes and the dumps by the algos, or the algorithms that run everything. And when they start to see selling begets sellings. And in a fraction of a second, you saw $3.5 trillion erased. And then quietly, the report comes out that says Russia is on record saying they're not going back to the dollar standard. Yet that day, Bloomberg pumps the opposite narrative, and that's the news. You know, that's the positioning news that we get. It's almost like they're running cover for it. Well, I mean, let's be fair. I mean, it's not the volatility, Dunnigan, is not just relegated to the precious metals. How about the not so magnificent 7? So far in 2026, you have Nvidia down 2%, Google down 2.5%, Meta down 3%, Apple down 6%, Tesla down 7%, Amazon down 14%, and Microsoft down 17%. This coincides with the strongest retail equity flows ever on record. But it's important to understand that when you talk about volatility, over the last 8 sessions, 115 of the S&P 500 stocks have fallen at least 7% in a day. Right? That's an internal breakdown, and it's happened only 1% of the time over the last 30 years. In particular, the index itself is only down 2.5% off its highs, but you have 115 stocks moving 7% in a day. And historically, when this happens, you're looking at a 35% drawdown, then last seen since 2000. So, you know, when you talk about volatility, it's not just in precious metals, first and foremost. I mean, look at crypto. There's volatility everywhere right now. This is a period of upheaval. This is a period of uncertainty, and it's not just relegated to precious metals. And before I talk about what's happening in the precious metals market, I mentioned the other day on a few shows, look, there's all these Asian AI channels. The only one that I have followed that I found to be accurate or ahead of the curve, more so than most anyone, is the OG John Agee. The rest of them I don't even watch anymore because of things like that. Things like these rumors that are not true whatsoever. There is no February 15th reporting requirement. There are no laws to confiscate metal. And I'm not sure why these things are being propagated, other than to say maybe it's in an attempt to get people to abandon ship. For that reason and that reason alone, I don't even watch the other ones. When I get this information, it's not very difficult for us to fact check it. We do, and find out that it's not really true at all. So bottom line is, there are no new laws surrounding confiscation or reporting or 1099 or Form 8300, like all of these various Asian AI channels have said. And the reason that I say OG John Agee is the only one that I have followed, you know, he's gotten several things right. The one thing that he got right before anybody, literally before anybody, was talking about what was happening with the refineries being logjammed because of the margin increases, and got that right. There are a lot of things he's gotten right. The one thing that I don't like about any of these channels, any of them, him included, is if you're going to say something about a leaked memo, at least show us the memo. You can redact as much as you want, but if you have the memo in your possession and you're talking about leaked memo, the one thing I was disappointed about was that they had talked about HSBC being forced to leave the silver market and cover all of their short positions by the end of January. They had talked about Morgan Stanley and JP Morgan, both leaked memos. All three were leaked memos, but those two in particular also, Morgan Stanley and JP, saying that they were going to leave entirely the futures market. So look, with any of these channels, you have to, I think, listen, take what you want out of it, but do your best to fact check it, to do your due diligence. And look, that's the one thing that I'm forced to do and you're forced to do 7 days a week. We spend all this time trying to gauge what's happening in the market. And I find OG John Agee to be a valuable source of information, but still, and I think he would agree, or whoever's behind that channel would agree that, no one gets it right all the time. You need to, and I was on Adam Taggart, and I misspoke. I talked about a regulation, and I thought it was the Genius Act, but it was actually the Bitcoin Reserve Act. And I came back on. I said I was sorry. I got it wrong. No one gets it right all the time. Do your due diligence. And the things that are really freaking people out, to my understanding, none of them are true. And I've done my best, not only through our operations, but also through my own due diligence to validate. None of that stuff is true at this point, as far as I can tell. The drawdown was crazy, no question about it. You look at a few things that have precipitated these drawdowns. You talk about the Bloomberg headline that ran cover for the paper smash, as far as I'm concerned, where they said Russia was going to jump back on the dollar standard. And this precipitated forced index selling, and along with the margin hikes and the dumps by the algos, or the algorithms that run everything. And when they start to see selling begets sellings. And in a fraction of a second, you saw $3.5 trillion erased. And then quietly, the report comes out that says Russia is on record saying they're not going back to the dollar standard. Yet that day, Bloomberg pumps the opposite narrative, and that's the news. That's the positioning news that we get. It's almost like they're running cover for it. But when you talk about what's happening right now in the silver market, look, we're 10 days away from the first notice day of delivery for the March silver contract. And I think people really need to understand what this means. As of Friday, there was 58,770 contracts that were left open interest, as it's called, that could stand for delivery. Each contract is 5,000 ounces, so that's 294 million ounces open interest right now for the March contract. A bunch of it has rolled to the May contract, because there was about 400 million ounces a week ago. So about 100 million ounces have rolled to May, which is the next big delivery month, not April, it's May. And that's normal, right? But it's still really very huge that we have 300 million ounces open this close to first notice. So I think what I take away from that is not a COMEX default, but even half of the open interest actually decided to stand for delivery. You're talking 150 million ounces that would need to get sourced, right? The problem with that is that the registered silver category, that is the available silver backing the contracts available to deliver, is about 90 million ounces, right? So, do the math. If demand for delivery spikes, COMEX has two options: either drain registered inventory very fast, which would be, I guess, a very serious drawdown, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. They will try and get people to roll to May by incentivizing cash settlements with a premium, anything to keep metal from leaving. And in my opinion, this is how the stress shows up. It's not in price, but it's in the delivery mechanisms and the delivery mechanics. And when the paper claims tower over the deliverable silver, I think the market is calm until it isn't. And so I think really what you're looking at is even a portion of this stands for delivery. 20% stands for delivery. You're talking, 60 million ounces of the 90 million. This is a problem. And so I think that's, to me, the biggest issue right now. What I'm watching is we'll see what happens over the next 10 days. At the same time, you still have this big $10 premium in Shanghai over the Western price, that this arbitrage is not going away. They're continuing to incentivize the people here in the West who have the ability to buy cheap, $75 or whatever, and sell it for $85 in China. A lot of people say, well, what about the difference in price is the tax. The VAT tax, right? Not tariffs, that there's a VAT tax, which is true, but it's not true, right? These are people who are not quite understanding the mechanics. The VAT tax is really there, but it's the responsibility of the recipient, because when metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver 50 million ounces at $10, you just made $500 million. That VAT tax is the responsibility of the recipient when it leaves the Shanghai exchange. So it's not paid until it leaves. If it stays there, there is no tax. So in other words, that arbitrage is significant enough at this point for a $10 premium plus like a 13 or 14 or 15% tax. They don't care. They want the metal. And so this is all, I think, noise. You have to see the big picture. You have to relax, see the big picture, understand it for what it truly is. And I think, yes, the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks that trade credit, not real metal. And real demand is showing up in Shanghai, and price discovery is shifting there. It's leaving London, it's leaving New York, and as long as the Western paper market stays disconnected to Shanghai like it is now, the physical silver will keep getting pulled out of the West and sent to where it's valued. And look, the scary part, it's even getting tight in Shanghai with premiums starting to blow out. And I think that's why, to me, the forwards and the futures are starting to feel almost undeliverable for a lot of people. This is why you're seeing backwardation, where the market makers are having a hard time sourcing metal. They can't hedge easily. Their exit becomes the move, maybe, right? And getting out. And I think that's what you see every time they smash the hell out of it. Are they doing it to get out along with stand for delivery? Are they doing it to extricate themselves from these stupid short positions that used to work before this was all, I think, figured out? Where, there are some very sophisticated traders around the globe, as I've been saying since 2020 on your show. The central banks have figured it out of the global south. Stand for delivery slowly. Don't do it too fast. Everyone says, why don't they just throw trillions of dollars at? Because you kill yourself. You cut off your nose to spite your face. They've been masterful at draining the exchanges all around the world. And that slow, insidious, little by little part, people can't handle. It's too monotonous. It's too slow. It's a nothing burger. But as you can see, we're getting to the point where they're running out of available silver to deliver. And that, to me, is all you need to see, on top of who's been standing for delivery every single month over month, for billions and billions and billions of dollars. They don't do this for the hell of it. What you see right now is just the volatility meant to throw the rest of us off the scent, off the trail, and join the highest influx into global U.S. equities in history. They want the rest of us in the pen with the rest of the sheep. At the same time, you got billionaire David Einhorn. I don't know if you saw that article, but he thinks that gold is well on its way to becoming the world's ultimate reserve asset. This is a guy that runs one of the biggest hedge funds in the world, and he's saying that it's already replacing treasuries, as we've talked about for the last several years, as central banks' reserve asset, because the confidence in this system, both fiscal and macro outlook, is getting worse. And when you look at China telling their banks to scale back treasury exposure, it's a signal to me that the shift for gold is far greater than the shift is for treasuries. They're selling them, and we've seen almost 900 tons bought in 2025 by the central banks, which is huge. So anyways, bottom line is, with both gold and silver, the fundamentals couldn't be stronger, but the volatility, I think, will continue to knock those who don't have strong fingertips off the back of the bull, who wants to take as few of you along for the ride as possible. All bull markets do that.